That's going to be one of the biggest themes, I think, this year, is a focus on which companies can actually replace reserves and grow reserves. And if they can't, what options do they have in terms of M&A?
Hello and welcome viewers to another update on the gold market and gold mining equities. I'm speaking once again with Fahad Tariq, who is Vice President of Equity Research in Precious Metals at Credit Suisse Securities. Fahad, thanks for taking time to share your insights again with us.
Happy to be here. Thanks for having me again.
Yeah, so a lot's happened since last we spoke. It's a really interesting time to be getting your views on what's happening in the gold market. So perhaps you could start us off with some of the headline themes that are really changing the trajectory for gold.
Yeah, so I think at the outset, I would say that we're pleasantly surprised with how gold has performed to start the year, and it's been much stronger than we would have expected. If you take a step back and you think about what's happening on a macro level, of course, central banks around the world, most central banks are now entering into a tightening cycle, increasing rates. We'll hear about the first rate hikes in about a month. And so in that environment, you would expect gold to not perform so well because interest rates are rising. The opportunity cost of holding gold is also increasing. However, offsetting that is some major concerns around inflation. And when I talk to investors now, basically the view out there, and we would share this view, is there seems to be an asymmetry in terms of gold's upside and downside from where we are. So the downside scenario is what I described. So the Fed is very aggressive in raising rates. Inflation also starts to cool down because of supply chains resolving and normalizing. And you have this situation where real rates keep rising kind of very quickly and gold declines. That's a possible outcome. The probability of that seems to be on the lower side. The upside for gold, however, there's multiple levers. You have the risk of a Fed policy mistake. So perhaps they don't raise rates quick enough and inflation keeps running really, really hot, right? In the US, we're looking at 7% inflation right now. In Canada, it's 5%. And then on the other hand, if the Fed raises rates too quickly, then perhaps they're creating recessionary type conditions, which would also be positive for gold. So no matter how you slice, the Fed's actions, it sounds like there's a risk of a policy mistake. And it sounds like, there's a high probability that gold would perform well in that environment. And then on top of that, you add some of these other factors, like the equity volatility we've seen to start the year. Obviously, the markets have been very choppy. And so a lot of investors are looking at gold as not just an inflation hedge, but also as a portfolio hedge against the other holdings they have. And then the last factor I would mention to start the year are some of the geopolitical concerns and tensions that we've seen. It's no surprise that on days when there are certain headlines about Russia, Ukraine, gold spikes. Today is an example of that. And then other days when that subsides and gold tends to underperform as well. So that's also a factor there. When we talk to investors, we don't place too much emphasis on that. Historically, geopolitical concerns and tensions, they tend to be transitory.
Yeah.
The inflation concerns, the interest rate moves, equity volatility, those have longer staying power and can influence the gold price for the rest of the year.
Excellent. Yeah, let's unpack some of those elements then and focus in terms of how you're seeing things unfold. Flipping back to the Fed and its more hawkish stance, how has that affected mining equities? Maybe that there's no simple answer for that, but equities seem to have fallen back a little bit. You would have thought that the gold price rising steadily, it would be favorable, certainly for the producers.
Yeah, I think generally speaking, the old gold equities to start the year to date, if you look at their performance, they're all generally positive with the exception of a few companies. And then you compare that to just broader indices like the S&P, Dow Jones, even certain sectors like the technology sector, and they're all negative. So gold has definitely relatively outperformed. The commodity has relatively outperformed. The equities so far have relatively outperformed. In terms of your question about the impact of the interest rate hike and all of that, the benefit of holding gold equities is that, of course, the gold equities move with the commodity. And the commodity is being driven by some of these macro factors. Again, the reason the Fed is raising interest rates is to control inflation. And the view that's out there is perhaps they're already behind the curve when it comes to that. And if that's the case, that's positive for gold. That's positive for gold equity. So taking a step back, what the Fed is doing on balance would be positive for gold equities because it's positive for gold.
Do you have a view whether the Fed's acting too slowly? You mentioned it before that it could be the case and that they don't react and inflation does continue to rise. Do you have a view on that, or are you just more advising about possibilities?
Yeah, I mean, look, I'm not an economist, but what I would say is the consensus view out there seems to be, at least among the investors I talk to, that there is a high risk that the Fed is behind when it comes to controlling inflation.
Yep.
And part of the reason is, if you remember last year, a lot of the commentary around inflation was it was transitory, and how you define transitory is debatable, but it certainly seems to be the case that, the inflation is very sticky, and we've seen it for a number of months now. And it's very, very high. And it's very difficult to imagine a scenario where the Fed, through its actions and the resolution of supply chain issues and things like that, just very organically gets inflation down from 7% to the kind of 2% where we'd like to be. It's just hard to envision that scenario. It really seems like a lot of this inflation is going to be sticky. And so the investors I talk to, they're very worried that the Fed and other central banks are really behind when it comes to containing the inflation. And that's why you hear talks about, will there be consecutive rate hikes, maybe a 50 basis point rate hike in March, that type of thing, because everyone's thinking, well, how can the Fed actually start controlling the inflation that we're seeing? The other thing I would say on inflation, and I don't think this gets much attention, is yes, on the one hand, you have supply chain issues, right, which will resolve as the pandemic ends, hopefully, and things get better. But on the other hand, you also have wage-based inflation, right? A lot of wages in many countries around the world are increasing, and that inflation is very sticky. For example, when supply chain issues resolve, prices can come down, but wages can't come down. So what we also tell investors is that's another argument for why you might see very sticky inflation and high inflation for a long period of time.
Yep, excellent. And what about wage price inflation, but also general costs of inputs, commodities, materials, energy for the operators, for the mining operators?
Yeah, so that's a good question, and I think if I just look back to late last year, there were a lot of investor concerns on OPEX inflation for the producers. Why? Because we were just starting to get this commentary around accelerating inflation, and some of the numbers that the mining sector was putting out there was 5 to 7% cost inflation, double-digit capex inflation. So investors started getting very concerned because there was uncertainty on the commodity price, and then there was also uncertainty on the input costs. And then you combine those two things, and so you don't really know what margins are going to look like for the producers. So what I saw investors do last year is a lot of investors rotated to royalty streaming companies. We saw this happen. A number of investors did this. Why? Because the royalty streaming companies aren't exposed to OPEX inflation. They don't have any exposure to the underlying costs. So that was a place that if you wanted gold exposure, you could kind of hold those companies and still have that without having the OPEX exposure. Fast forward a few months to where we are now. There's much more clarity on the commodity price, as we've discussed, and there's actually much more clarity on the input cost too. Almost every company that I cover has now come out with their 2022 cash cost guidance. And if I just take an average of what everyone is saying, it is shaking out to be about 5 to 7%. For example, Barrick said 5%, Newmont has said 4%, Kinross is saying 7%. So these are some examples of what has been put out there. So there's much more clarity on the 2022 costs. And I think investors are happy that they have that clarity, but also that the assumptions that are underlying this guidance are pretty conservative. So if you ask any of these gold companies, what is it that you're assuming in terms of inflation when you say 5 or 7% inflation? And they say, we assume supply chain issues for all of 2022, which is a pretty conservative assumption. Presumably some things will start getting better and there's potential for those costs to be lower. So that's kind of where things stand now. I think there's much more comfort from investors on costs, and they have more clarity and visibility on it.
Excellent. Okay, well, we've talked about sort of supply chain issues causing sort of operationally challenge, but demand for commodities overall is at all-time highs. Everyone's building out, and then we have record prices in a number of commodities, as well as a pretty strong gold price, at least for producers making money. how do you see the reserve replacement challenge that the gold miners are facing in relation to the demand story that's really quite strong?
Right, right. So if I think about like every year in recent history, there's always a theme in the gold mining sector. So in the past 2 years, I would say the theme among investors was capital return, right? How much can companies generate in terms of free cash flow, and how much can they return in terms of dividends and buybacks? The theme for this year, a big theme for this year, will be exactly what you said, which is the reserve replacement challenge.
Right.
And we're just starting to see that with companies reporting their year-end reserves. And if you just take a step back and look at the entire sector, this is becoming a pretty significant challenge for the gold mining producers. You know, all the easy gold in the world has been discovered. You're seeing more underground operations versus open pit. Discovery grades are declining. Many producers are having a hard time just replacing what they've mined every year, let alone growing reserves. So that challenge, I think, will continue. You know, it's been a secular trend over the past several years that we've seen this, and I think you're just going to see that continue. And one of the ways that companies will get around that, if they can't find that reserve growth organically, is then they will then look to do M&A. And so when people talk about M&A in the gold sector, many people think it's just to get scale and become larger and, you know, have a bigger market cap. And yes, that's part of the equation, but part of it is also they're just trying to grow reserves and have that longevity that many producers are having a hard time doing. And so you're seeing mine lives slowly creep back lower and lower for many of the large producers. So that's going to be one of the biggest themes, I think, this year, is a focus on which companies can actually replace reserves and grow reserves. And if they can't, what options do they have in terms of M&A?
Yeah, excellent. In terms of the companies you covered, do you think anyone's doing it particularly well? Do you think anyone's got a sort of, you know, what you're recommending to investors? Do you think one of the majors is certainly well positioned with that mine life capacity?
Yeah, so I mean, the good thing about the majors is that, you know, if you think about a Newmont or a Barrick, they don't necessarily have to discover any more gold for them to have a stable production profile for the next decade. So they're in a position where they're very stable production profile. You know, the reserve replacement challenge still exists for them at the individual mine site level. But in terms of, you know, producers that we think have a really good potential for reserve growth, Endeavour Mining is an example of that. Their mines are located in West Africa, you know, exclusively, and they just have one of the best reserve growth profiles, exploration potential, project pipeline that exists in the sector. So that's one that we're very confident about. And even more recently, you've seen Barrick, for example, announce slight increases in reserves. Kinross also announced a slight increase in reserves. So some of the larger companies are able to do it. I think the challenge you'll see is you'll see it definitely among the smaller companies for sure. But yeah, I mean, those are some of the names that come to mind. But just taking a step back and looking at all the producers on average, it's a huge problem. And I think it's only going to start getting more and more attention as companies report their reserves.
Certainly. Yeah, Endeavour's a great story, but some of that's come from M&A as well. And that leads to my next point around M&A. You know, like there's a quick way to do this. Are we about to see an explosion in M&A to tackle this challenge? Is it a good time for the juniors in a way because they're going to be able to spin out assets, or maybe there's too much saturation in the junior tier and not enough quality assets? What's your take on this?
Yeah, so in terms of M&A, that question comes up a lot because, and part of it is, again, people are looking at the reserve growth challenge and thinking, well, that means that there needs to be M&A, there needs to be consolidation. And obviously there's this view out there that there's too many gold companies trying to, you know, discover and mine very, you know, limited ounces. So my view and our view is that we're going to see more consolidation. I think you're going to see it more in the intermediate gold space, so the smaller producers. I think if you think about the senior producers, whether it's Newmont or Barrick or Agnico Eagle or Kinross, a lot of these companies have already done pretty significant M&A, with the exception of Barrick, which, you know, they've been very public about, you know, being open to doing a large scale acquisition. The comments were made about that even this week. So Barrick among the seniors potentially could look to do something like that. Among the intermediates, you know, I think there's many companies that could be acquirers or acquired. And again, it's because they want to get that reserve growth, that production growth, that scale. And you know, the only limiting factor I would say is obviously we're in a pretty elevated gold price environment, and so it's kind of unintuitive, but that can prevent deals from happening, because if companies are trying to be disciplined about what they're paying for an asset, for a mine, for a company, obviously the selling price would be higher today than it was 3, 4, 5 years ago, because gold prices were lower then. So that is a limiting factor, right? And so the concern among investors is, yes, we see the need for M&A and consolidation, but we're also concerned on discipline and what the premium you're paying for the mine, for the asset, for the company. And so that's going to get a lot of attention. So in short, I would say, Barrick among the seniors, very publicly open to doing an acquisition, a large scale acquisition. I think the other senior gold companies will probably look to do, earlier stage individual assets in jurisdictions they like. The intermediate gold companies, I think you'll see much more mergers of equals and kind of consolidation there.
Absolutely. My last point around the sector is your take on sort of how large mines are enforcing responsible stewardship of assets. I'm thinking about how a generalist might look at the sector, typically would look at gold and then maybe the gold equities before they got into mining in general, and how this role of stewardship of assets and pertaining to ESG is coming into such an important factor for when people are assessing these companies. And do you think the sector as a whole is doing well? Do you think the gold sector perhaps leads mining in respect of some of their standards, whether it's the environmental or the social?
Yeah, so I mean, I think part of it depends on what part of the cycle we're in. So obviously, when there's concerns on some of the macro factors we talked about and strong views on the gold commodity, tends to be less discussion on ESG, and everyone's just focused on positioning and where can they get the biggest return from if they think gold prices are going to go higher, which companies have the most torque. So those types of discussions happen. But assuming gold prices stay kind of flat and stable, there is a discussion on ESG, and it's growing. And you see this from the companies too. Almost every presentation now has a considerable number of slides dedicated just to ESG. And so, the gold sector historically, I would say, has lagged when it comes to some of these ESG initiatives. You've seen a lot of the base metal companies come out first with 2050 targets for net zero emissions reduction targets before then. And what you've seen more recently is the gold sector is catching up. So almost every senior gold producer now has come out with a 2050 target to be net carbon neutral or net carbon zero, and also come out with 2030 targets to reduce emissions by 20, 30%, et cetera. So there is a much more concerted effort now to kind of catch up to other mining sectors, basically, when it comes to ESG. Where the gold sector has done a very good job, and I don't think this gets as much attention as it should, is in terms of the economic impact, the positive economic impact it has in the community. So a lot of investors focus exclusively on the emissions and the energy needed to mine, which is absolutely something that needs to be addressed, and companies are starting to do that. But on the other hand, one thing that I don't think gets enough attention is just the amount of contribution economically that these companies are making in individual host countries, whether that's directly through salaries, supplies that they're buying locally, even community programs that they have. In some countries, these are some of the best paying jobs. And I just think that the mining sector can do a better job, and the gold mining sector specifically can do a better job of highlighting that positive impact as well. But that aside, of course, there's room for improvement when it comes to renewable power, battery electric fleets. Like, these are some of the things that mining companies are looking at. And it's just very encouraging to see that they're taking this very seriously, and they understand that investors really care about this fundamentally. It's not a surface level exercise. It's something investors really want to see gold miners do a much better job on lowering emissions objectively, improving their water use, improving their safety performance, all of those things.
Excellent. And just a final quick outlook then. So do you have a bullish sentiment on gold price this year? And are you bullish on the mining equities?
Yeah, so I mentioned at the outset, we think there's an asymmetric setup here for gold, more upside potential than downside. Yep. That's still our view. So I would characterize that as bullish or constructive on gold. Our house view in terms of the actual commodity price is that gold will average about $1,850 this year. Right. And that is up from last year. So last year gold price had averaged about $1,800. And I think one thing I'll just say on the commodity price, a lot of investors get hung up on whether it's 1900 or 1700, 1800. But one thing to consider is any of those prices in between are very, very healthy levels for the vast majority of producers. You're talking about all-in sustaining costs around $1,000 an ounce. That's a pretty significant margin to return to capital, to return capital to shareholders, to invest in projects, to maybe even do M&A. So, we always highlight to investors that whether it's 1700 or 1800 or 1900, we can debate that, but anything in between is a very healthy price for the sector.
Absolutely. Excellent. Thank you very much for the update. It's really good to get a steer on where we're headed and some of the interesting opportunities and risks that are facing the sector at the moment.
Great. Thanks for having me.
Yeah, thanks for speaking with us, ATV.